Good.
Good morning, Chicago. How is everybody doing today? I'm excited to be here. Thank you for this opportunity to speak with you all today on financial reports and helping you understand that they're just not spooky. I'm very excited to share a few things about that from my 20 years of business knowledge, and that the City of Chicago has partnered with NAWBO, the National Association of Women Business Owners, to help bring you guys this information. So we want to get to the topic. And one of the things I've asked Stella to do is to put up in the chat some handouts. And I would love it if the folks would take a look at the handouts that Stella's going to be adding into the chat and have them at hand, either up on your screen, or the other option is just to have them available to you, even if you could print them and scribble notes on them, because it's my feeling that a lot of people get freaked out about their financials and understanding these reports. And sometimes it just helps to have an expert to help you walk through those financials and take notes and just and do all the things, the scribbles and the questions and all the things that don't necessarily make sense to you. One thing I know is that for most people, we got into business because we're good at doing a certain thing, and reading financial reports probably isn't at the top of that list of our skill set. So I want to encourage you to take notes, whether it's in format on the screen, or if you're able to print and scribble down notes, that's a great way to go as well, because it will help you retain the information. So the first thing that I wanted to discuss with you today is that financial confidence and understanding your financial reports is really going to help you build and lead a better organization, because those financial reports, they do tell a very juicy story about your business, and the way you have them set up is super, super powerful. So the thing that we focus on at Reconciled Solutions is making sure that our clients have access to clean, accurate, and descriptive financials so that they can make great business decisions. And a great business decision, we really help clients kind of put a framework around their financials, because the financials should be doing three things for you. The three things is one, they should help you save time. So time saved is very important, because you are not spinning your wheels trying to find things, right? That's how we save time with our financials, is just having everything in order and not having to search through old emails and things of that nature to try to understand where that one piece of information is. If our financials are organized and put together well, then they will help save you time, because you'll be able to pull up information at the click of a fingertip. The other thing that financials do is we can save time via time invested. And what I mean by time invested is that we need to ask big questions to help move our business forward. What is it we need to do today in our business? Because I know certainly as a business owner, I have a list a million miles long of to-dos, right? And what's going to rise to the top, I want it not to be the greatest and latest fire. I want it to be the thing that's going to drive the business forward. And with accurate and clear financials, time invested becomes very valuable, because you learn the things that you didn't know, because you're able to use the financials to add to the gut feeling that you might be having about things that you need to change in your business. The other way that financial confidence is super important, and you're all doing this today, is to use time well spent. So if you feel any lack of confidence or clarity in your financials, that's what we're here to do today, is to help you get your arms around that and to be clear about what your financials are telling you. I said before, it's the juicy story, right? There's a juicy story in your financials. And today, hopefully, I'm going to give you some points that are going to help you understand that better. So where we're starting today is with the chart of accounts. We'll move to the profit and loss report and then the balance sheet. And if we have time, the statement of cash flows. It depends upon how many questions you have. So we're going to get started with the chart of accounts. A lot of people don't know what that is. The chart of accounts, let's see here. All right. So the chart of accounts, I like to say, is like the index for your recipe book. So if you look in the back of any good recipe book, there's going to be a section for appetizers. There might be a section for desserts. There's a section for mains. That's the same way a chart of accounts works in your business. What I'm sharing on my screen, make this, there we go. All right, what I'm sharing on my screen is a test drive QuickBooks Online file. It's just an example with real transactions in it, and it shows you the homepage of Craig's Design and Landscaping Services. If you take a look at that and you want to find the chart of accounts, one thing about QuickBooks Online is that everything's in 2 or 3 places. You can find it in different places. So one way that you can find your chart of accounts is to go over to this left toolbar and just scroll down until you see it as one of the options. So it is under transactions. That chart of accounts is right here. And then the other place I was just going to show you is this little settings tab at the top, that little widget up there, and it has pretty much all the things there. So if we wanted to find the chart of accounts in this list, we'd be able to do so. So I'm going to pull up the chart of accounts and show it to you what it looks like for Craig's Design and Landscaping Service. The things we're going to see first on this list are cash accounts. There's a checking account, there's a savings account, and then immediately we start going into assets. So what I want you to realize is that these main topics are just like the main topics in a cookbook index. So instead of appetizers, we're going to have a list of assets and cash accounts. We're going to have a list of liabilities. There's equity, there's income. You're going to find cost of goods sold. There's a cost of goods sold here, and then there's expenses. So those are the main sections in our recipe book. And then we use those main sections to drill down and to understand the different things that are going on in the business. So if we look, for example, at some of the income items, there's other client income, there's pest control services, there's refunds and allowances, there's sales of products and services. These are all different recipes, so to speak, in your chart of account under the income section. Okay, so that's what I wanted to share about the chart of accounts. This is the basis for everything that happens in your company and where you will find everything. Now, Geraldine and Stella should have put up the handouts link in the chat. So hopefully that's there. I'm going to open the first page of that, which is the glossary. And because I have only one screen today, I'm just going to check that you all can see it. I want to look at my chat. All right. So were we able to get that in there? Otherwise, I can add it. Okay, I see Paul is looking for it, so why don't I add it to the chat, okay?
Hey, Angie, really quickly, in order for me to share these documents on this platform, I must convert it into a link. So that's what I'm doing right now. So it's
Oh,
taking a
okay.
while. It's taking longer than expected.
All right, thank you. I appreciate that. We'll get that up as soon as possible. Okay, so what you're going to find on there, one is just a glossary of terms, and it looks like this. And that glossary of terms is going to have, it's the basic things you need to talk about accounting. So if you speak French and German and Chinese, you can also speak accounting, and that glossary of terms is going to help you do so. The next thing we're going to look at, so that's just a resource for you if you're not understanding something that I'm saying, to go back and look in the glossary of terms. The next thing that we're going to look at and spend quite a bit of time at is the profit and loss statement. So let's get to that profit and loss statement and start talking about it. Okay. So I have an ad agency profit and loss statement from January through December of 2023. This is a limited liability corporation, LLC, otherwise known as an LLC. LLCs are going to do things a little bit differently than an S Corp and then a corporation, and different than sole proprietorship. So the things that you're going to see on this profit and loss are specific to an LLC scenario. We see a lot of small business owners that are LLCs. This company in particular has the income split into three areas. There's a billable expense income. There's a sales category of business to government, and there's a sales category of business to business. Those are all three pretty descriptive. The billable expense income would be something that you are paying for on behalf of your customer, and then you're billing them back for it. So in this case, there was $3,000 of expenses that were purchased on behalf of the customer. It's an ad agency, so I would consider things like Facebook ads or Instagram ads, things of that nature. It might be an ad spend where the customer is really responsible for paying you back for that, and you're not charging any markup on it. So you would put it under your billable expenses and then bill them back for it and collect for it. The main two resources you can see here, the main two things that they're selling are business to government ad support and business to business support. And we can see then that there's 316,000 in 2023 of business to government sales and 1.1 million in the business to business sales. Over to the right, you're going to take a look at those percentages. Those are percentages of the whole. So the total income for this company was 1.426 million, of which sales of business to business really led the way. And sales for business to government were 22% of their sales. So it's interesting to think, well, why aren't they just selling business to business, since it's so much more sales for them? But really what's important when you're looking at a profit and loss is making sure you understand what the value of each of those sales is. So we're going to do that by looking at the cost of goods sold. So a cost of goods sold is in the business would be the things that you need to provide for to get your product out the door. So in the case of an ad agency, they are likely hiring subcontractors to put together the ads, to put together a marketing strategy, and things of that nature. So the subcontractors and the time and money that you spend to pay those subcontractors and or employees to deliver the ad strategy and ad content would all be considered a cost of goods sold. If you're a maker, it's the materials that you need to make the products that you're making. So in a dog walking business, it's the actual dog walker, the person that's taking the dog out for a walk. In a bakery, if they're making chocolate chip cookies, it's the flour and the chocolate chips and the sugar that goes into the recipe for the chocolate chip cookies, et cetera, et cetera. If engineering is your thing, then it's the CAD drawings and the labor it takes to get those drawings done and things of that nature. So that's what your cost of goods sold is. What's interesting about this profit and loss is that we've divided up the cost of goods sold into the same things as we did the income. So you're going to see here cost of goods sold business to government. And under that, there was $37,000 spent on subcontractors for the cost of labor to provide business to government services. Okay. The same thing up in the income, we can see we sold $316,000 of business to government, and we only spent $37,000. When we look at B2B, there was $333,000 spent in research services and $286,000 spent on the subcontracted services. So the total expense to deliver the $1.106 million of B2B sales that you're going to see here in this line, the total cost to deliver that was $620,000. It was the total of the research services plus the cost of labor of $286,000. So that equaled $620,000. So if you take a look at the total cost of goods sold, which your total cost of goods sold is here in line 21, and it's $657,000. So it is the total of that $37,000 that you're seeing in B2G costs, plus the $620,000 in B2B, that total being $657,000. We're gonna see that our total profit, our total expense of the revenue as a percentage of revenue is 46% over here. So I'm showing you that 46%. This is a critical number because it means that for $1.4 million of total income, that we had to spend $657,000 to provide that. So 46 cents on every dollar collected went back out the door in the area of labor. So these are labor things that went back out the door to provide it. And then this gross profit here is what's left over. Now, I'm a big believer in profit first. This is a cash management system for your small business in which every dollar has a purpose in your business It's kind of like grandma's envelopes, amped up, because we use, instead of having envelopes in grandma's purse that has money set aside, cash, it's got $100 bills in to go buy groceries, and it's got $400 to pay the rent and things like that. We allocate our money in Profit First using bank accounts. So we will set up multiple bank accounts, and each bank account has a purpose. One of those would be the materials and contractors, which for this business, this ad agency business that we're looking at today, 657,000 of the 1.4 million collected would be considered to be going out of that materials and contractors. So this is important because we not only have to understand our total cost of goods sold, which in this example is 46%, but we also need to look at the gross profit, which is 54% in this case. We can see that number right here. And that 54% is important because we haven't paid ourselves yet. We haven't paid for office supplies yet. We haven't even paid for fuel in our car or our cell phone service yet. So what I'm saying is that the company sold $1.426 million. We sent 657,000 of it right out the door immediately in cost of goods sold. And what's remaining is $768,000. We have to pay everything else in our world with $768,000. And that's a really important concept, because you can have $1 million company, but if you spend 999,000 of it on your cost of goods sold, then the very most you can make is $1,000 at the end of the day. So we can't spend it all on cost of goods sold. One could say that your cost of goods sold is really that gross profit. I'm sorry, I'm going to say it again. One could say that gross profit line in your business is really your whole revenue, because this is how you're going to live off of it. Okay. It's the 768,000. People like to brag that they have a $1.4 million company and they're doing so well and life is good. But the truth is, they really only have a $768,000 business in this case, because if you're spending every single penny that you have on your cost of goods, there's nothing left to pay anything else. And that's what we're in business to do, is to make a profit, to make sure that we are utilizing our money so that we have a decent amount of owner's pay. We can live on it. We can pay our taxes. Maybe we even have some additional profit so we can go on a bougie vacation. Or if you're like me, I like really nice purses and really nice shoes. And so I have a shoe habit and I have to buy really nice shoes. I spend my profit there. Okay, excuse me. Okay. Now, within the cost of goods sold, we have this column. It's showing a few other calculations. So one thing I want to point out is that we've divided the cost of goods sold in the same way, in the same silos that we have divided our income. So that would be the sales B2G and the sales B2B. And the reason that we do that is that we can understand the gross profit from any given line. So in this case, we can see that the cost of goods sold for the B2G business is only $37,000. That means only 12% of the revenue collected, the 316,610 right here is being spent on the cost of it. So that gives us a really, really high profit margin, right? So we may only be selling $316,000 in B2G, but the profitability of that business far exceeds our B2B business, because the B2B business, we've sold $1.1 million of sales, but the cost against that was 620,000, which is 56 cents on the dollar. So what do I mean when I say 56 cents on the dollar? It means for every one of those $1.106 million that were collected, 56 cents of it went back out the door. And so only 44 cents goes towards your gross profit. Whereas on the other hand, the business to government, we only sold 316,000, but we kept 88 cents on the dollar. Only 12% of it was our cost. And that's really powerful information. That's the juicy story that our numbers are telling us if we're able to line them up in such a fashion that we understand those silos of revenue. So we want our income to align in the same silo of revenue as does the cost, right? So then we can say, okay, we're selling B2G services, we're selling B2B services. The B2B services, they're the lion's share of our business, but we don't make the margins on B2B that we do on B2G. So then we start asking ourselves things like, okay, you know, where is my sweet spot in delivery? Like, is B2G easier for my team, or is B2B easier for my team? So thinking through those kind of things. And if it turns out that you get less B2G business, but you know, it's absolutely in the sweet spot of what your company does well, and you have a unique offering, then I would encourage you to sell way more and spend more time and energy trying to get those B2G sales, because the revenue and the profitability on that product line is so much better than your B2B business in this situation. So it's having that data lined up into silos of revenue so that you can see, these are the things I offer, these are the expenses that I have against those things that I offer. And I can understand from this situation what my most profitable and my least profitable is. We've often heard people talk about the lost leader, your lost leader. And the lost leader is something that pretty much, you know, most of the revenue goes towards the cost of it, right? But if you can get people in the door with your lost leader, and then they're going to buy other products that are going to have good margins, then maybe the lost leader is worth it. These are the kind of things that we can tell by looking at the income and the cost of goods aligned into silos of revenue in our profit and loss report. So it's not only important to understand the percentage of sales and the dollar of sales that comes from each type of revenue stream, but it's also important to understand the percentage of cost and the dollar amount of cost that comes from each revenue stream. Okay, so then the next thing we're going to talk about is the expenses. So now we know that this gross profit line that we have here, 768,000, we're going to use that money to pay for everything else in the business. And what is everything else in the business? Well, everything else in the business is going to be all of your expenses, all of your owner's pay, and your taxes, and any profit that's left at the end of the day. What we do at Reconciled Solutions is we divide up our expenses into general categories as well, so that we really understand what portion of the business those expenses are. So in this example, we can see that there's a set of expenses associated with number one, administration. So this is often thought of general and administrative, if you've heard that concept in your business. And general and administrative has some of these things in it. It has the bank fees and service charges. It has the insurance. It has what you're spending in accounting support, consulting fees, legal fees, dues and subscriptions. There's a lot of secrets in your general and administrative expenses. So if you're looking to cut costs, one of the first areas to look would be your general and administrative expenses, because they are small oftentimes, like seats in Google. So say you have 15 seats in Google at $4.99 a month, but you only have 8 people working now, and you forgot to get rid of the 7 seats that are unused. Those things add up. Devil is in the details. And I would say that general and administrative expenses, they tend to be the junk drawer of our business. We just shove things in there and we forget that those things are in there, and they add up. So just in terms of cost valuation and making sure that you're using every dollar and every penny that comes into your business purposefully, I suggest looking at your general and administrative expenses at least once a quarter and making sure that you're utilizing everything in there. I've found lots and lots of stuff in there through the years. The other main categories that we're going to have in a small business, one is the general and administrative, 2 is payroll, and 3 is going to be occupancy expenses. So rent or lease and your utilities and things like that. Those are the 3 big ones. And then based on the size and complexity of your company, we might add other things. Some of those other things right now in this example are up in our general and administrative number 1 category. It is easy to separate out the amount of money that you spend on advertising and marketing, because this is also an area where people will tend to spend a lot, or on the flip side of that, a lot of small business owners don't spend very much at all. So as your business grows, it might make more sense to pull your advertising and marketing expenses as a big group out of your general and administrative, so that you can get a better handle on how that money is being spent. The same could be said for things like research and development, and productivity costs. So productivity costs being like if you're sending staff members to training and development and things of that nature. So some of those can be broken down further if there's a need for it. The big 3 that you're going to start with in a small business would be general and administrative, payroll expenses, and occupancy expenses. So those would be the big 3. I wanted to look at the payroll for a moment here. Oh, general and administrative, this total came to $35,000 on line 55. We're seeing that. And that's actually 5% of the total expenses of the business. If I look down here, I'm going to find total expenses. They were $329,884. And the general and administrative expenses portion of that made up 5% of it at $35,706. The payroll total was total payroll is right here. It's 38% of the expense, $290,000. And then the occupancy for this company was only $4,000. likely, this is a company that works from home. So many of us work from home right now. We're not spending money on rent or lease or buying a building, that kind of thing. So, occupancy in the 2020s is such that a lot of times people don't have a lot of expense in this area, at least for small business owners. Okay, one of the things that we have the most expenses on is going to be payroll, right? So we've got our payroll here at 38%. It's 38% of the total $329,000 of expenses, and we spent $290,000 on our payroll. I want to show you how this payroll is aligned. So for this small company, we have a section for employee benefits. It has the employee health insurance and the owner's health insurance, and then the total of health insurance. There's a simple IRA contributions. There's a workers' compensation line. And then we have payroll expenses for production workers. So in this case, it's an ad agency. So we have an art director, wages and taxes. So that's the payroll taxes. And then we also have some subcontractors. So you can see that the total payroll for production, getting our products out the door, is $102,000. And we can see specifically that we have an art director that is an employee, and we pay taxes against that employee. We also see that some is considered subcontractors, internal. So those folks would not be doing general and administrative tasks. So if you have somebody that's a virtual assistant to you, an in-person assistant to you, an office manager, an operations manager, any of those folks, they are not involved in the production of getting your product out the door. So they would be labeled separately. So we want to think of those in the same categories, likely that we're thinking of our expenses. So on the profit and loss for Reconciled Solutions, I have my bookkeeping and accounting team. Those are my production workers, and I keep their wages separately from what I pay to my general and administrative staff, which includes my virtual assistant. It includes my operations manager. It includes my business development person. Okay. So I have a question for you. I'm going to tell you right now that the answer has to do with the entity type, but what is it we're not seeing in this payroll? I don't know if you're going to notice this or not, but if you know what we're not seeing, what group, what person is not being accounted for in this payroll, I'd like to hear that. And I will give away a Profit First book to anybody. Oh, I see it. So Felix Vogel, it looks like you're the first person, the owner, and we have a bunch of people, Gloria Thompson. All of you are saying like the owner's pay is not here. So Felix, if you want to just DM me, and put your address in, I'll send you a copy of the Profit First book. Okay. So his answer is right. We are not seeing owner's comp in this profit and loss statement. The reason we're not seeing it is because this is a limited liability corporation. I had that up at the top. So limited liability corporation, usually LLCs are single members, and a single member LLC cannot put the owner's pay on their profit and loss. That would be on their balance sheet. Now, if you're an S Corp, you can take a payroll. You can set your salary at $100,000 or $200,000. And if that were the case, then it would be in the payroll section here, down here in number 2, you'd have like the payroll for production, and you'd also have one for payroll, owner's comp, officer's comp, something like that. And you would have all the costs that go there. What we do see for the owner in this case is the owner's health insurance, and $2,500 was paid over the course of the year for owner's health insurance. That is an owner's benefit, and it would be considered part of their owner's comp pay. So that's exciting stuff. I'm glad you saw that, Felix, and we had several other that did as well. Much appreciated. Okay, I just wanted to talk about then total expenses and net operating income. So now total expenses, that was the total of what we spent on administration, payroll, and occupancy totaled out at 329,000. We know that the total sales for the company were 1.4 million, and then we spent 657,000 right off the bat on the cost of goods sold. So the 400 something thousand that was in expenses, it came out of this 768,000 of gross profit. So you're sitting here with 768,000 of gross profit. And if you go down, you're going to see then the total expenses were 329,884. That's the administration, payroll, and occupancy. And the remaining net operating income is $438,000. So I have another question for you. And again, I'm happy to get a Profit First book over to somebody who might have this answer. And the answer that the question that I'm asking is, what is the taxability of this LLC? So what will the owner of the business be taxed on? The net operating income, Danica. Excellent. The owner would be taxed on the net operating income. So ding, ding, ding to you. Again, Danica and Felix, what I'd like you to do is private message me with your shipping address as well as your email so I can connect with you afterwards. Maybe Profit First isn't the right book for you. If not, I have other options. But Danica's right that we are going to pay taxes against the net operating income. In this case, this company is killing it, man. They've got 31% net operating income, which is very, very high. So I just wanted to share that with you, that this company has spent in total 43% of their total revenue of 1.4 million on expenses. They've spent what, 46% on cost of goods. And at the end of the day, they have $438,000 net operating income. They will pay taxes on that $438,000. Now, there's different things we'll cover in the balance sheet that shows, because in this case, this is an LLC, the owner has not yet been paid. So we can assume that some of that 438,000, let's say about 30% of the net operating income would go to the owner. So you're looking at over 100,000, under 150,000, you'd keep for yourself. That still allows somewhere around 300,000 to be reinvested in the business, taken out as a profit distribution, paying off debts, all of those other things that have to happen in your business as well. So before we move on, I'm just going to look at the chat once more to see if anybody has any questions they want me to answer about the profit and loss. You can type them in the chat for me. And while you're doing that, I'm going to start moving on to the balance sheet. So my balance sheet is the next tab over. The balance sheet for this situation is an S Corp. And we're just going to talk about the balance sheet for a moment. All right, a balance sheet is a summary of your business assets. That's what the business owns. And it's a summary of the liability, which is what the business owes. And at any particular moment, it shows the money you would have left over if you sold all your assets and paid off all your debts. And that would be in the form of equity. Okay, so many of you have probably heard this formula that assets are equal to liabilities plus equity. It's so important that I'm going to type it in the chat. So assets are equal to liabilities. Okay. So the reason that's so important is because it helps in the valuation of your business. And you would take a look at your assets, you would take a look at liabilities or what you owe to people, and see how much of the business you have been able to keep in the form of equity. That's money that you're able to take out. Or it's that money, in this case, there was $400,000 of net income on the profit and loss, and that would sit in the equity, even though that equity might be made up of a portion that you used of the 400,000 to pay off debt, another portion to pay yourself, and another that you just left in the business as cash flow operations. It's the cumulative of those things. So if we're going to talk about assets, assets are the cash that you have in your business. So in this case, the company is following a profit first method. So they have a bank account for contractors, one for income, one for OPEX, one for payroll, one for profit, and one for tax. So the total of their bank accounts is $30,000. So they have $30,000 at this moment in time, which is December 31st, 2022. They have $30,000 in cash sitting in the bank, right? Okay. So then the accounts receivables is at 0 right now. So accounts receivables is the money that your customers owe to you. Now, this company looks to be a cash basis filer. You might hear cash versus accrual. Are you a cash basis filer, or are you an accrual basis filer? So that what they're talking about is how do you file your taxes? And if you're filing on a cash basis, it means that money is only received into the company when it's actually collected. So if you have a client that owes you $5,000 and they haven't paid that $5,000 yet, we wouldn't see it in a cash basis accounting. If it were an accrual basis accounting, we would see it the second we made the invoice. So we invoiced the client for $5,000. It would appear in our accounts receivables as $5,000 that's due to our company. And then when the client says, okay, it's time to pay this $5,000, they pay it. It's likely gonna make the accounts receivable go back down to 0. And what will change is the income account. That $5,000 would go up. So instead of $2,600 that they have in the bank account, they're going to have $7,600 in the bank account because they deposited that $5,000 into their income. So an accounts receivable in a cash basis business is not going to show on the balance sheet because we are not taking credit for the things that we have not been paid for yet. There's some other current assets here that do add value to your business, and we often forget to think about them, but it adds value to your business if you have a security deposit. So say you had to put $5,000 down on the place that you're renting, that security deposit would sit there as an asset on your business. Some of the other things that would be assets on your business are equipment. So in this case, the owner has $8,000 worth of computer equipment. They have almost $11,000 of office furniture sitting around. And then they have a BMW. The company owns a BMW, and there's a $47,000 value to that BMW. Now, these have AD in front of them under the computer, under the office, under the vehicle, the BMW, and that's accumulated depreciation. So there's certain things I like to call funny money in business because it's the things that tax preparers do that aren't necessarily tangible, okay? And accumulated depreciation would be one of them. So say you bought that BMW for, it was a $60,000 BMW, and you've got to make payments against it. But you know what happens with a car? The second you drive off the lot, it's not worth as much, right? Cars depreciate in value. So this is the accumulated depreciation of that. So in the case of a BMW, maybe they are writing off the value of the $60,000 purchase over 5 years. So that's $12,000 a year. So you would see that funny money or accumulated depreciation on your balance sheet of, you know, I used the car for a year. So now it's not a $60,000 value anymore. It's a $48,000 value. So that's the kind of things that you're going to see in accumulated depreciation. And I like to call it funny money because it is the things that accountants do. It's not cold, hard cash in your pocket, but you need to have those things calculated because it contributes to the value of your business. And all of us, every single one of us, doesn't want to work for 30 years in a business and then say, yeah, I didn't accumulate anything. I can't sell this business. It's not worth anything. What we want is, we want to say, I worked 30 years. I worked so hard. The business learned how to be profitable. I learned how to make the business profitable. And at the end of the day, I'm going to be able to sell this business to somebody for a value. And that's what we use the balance sheet for, is to try to figure out some of those things. All right, so going down. Yes, so we have that, we didn't know that rental workspace qualify. Yes, it definitely does qualify. That security deposit, because what's supposed to happen at the end of our lease, if we move out of that space, we're supposed to get the damage deposit back. Right now, we might not get the 100% of the damage deposit back, or we may get the damage deposit back with interest, but we're going to have that money returned to us. So it is an asset. It is a value to your business. Okay, so just talking about liabilities. So credit card liabilities, that's the money you owe to your credit card company. There's a bunch of payroll liabilities that we're seeing here. And what I want you to realize with payroll is that we set somebody up with $120,000 salary. So $12,000 a month. Well, 12,000 doesn't show up in your personal bank account. It's 12,000 less the payroll taxes. And the company has an obligation to pay some of those payroll taxes, and the individual has an obligation to pay some of those taxes. We call those payroll liabilities, and we have to understand that that money is not ours and it is not the business's. And that's why it sits as a liability on our balance sheet, because it's not my money and it's not the company's money, it's the government's money. Okay, so we list that stuff there because it's stuff we have to pay to the government in order to continue doing business. Now, we said that this person has a BMW. I forgot what the value of it is, but it doesn't look like they have a loan on it. There's $0 loan value. But the truth is that most people have loans on their vehicles. So if you own a BMW through the business, it was a $60,000 purchase. You funded $10,000 of it. You still have a loan for $50,000. And every month you're paying $500-$600 on that BMW, and the portion that would be the principal would make this payable go down. The loan amount would go down, and the interest paid. So let's say you have a $600 payment, of which $200 of it is interest and $400 of it goes towards the principal. Then the $400 payment would go down on this line, 2,600 loan BMW. So instead of, owing 50,000, you're going to owe 49,600, right? Because you paid 400 down on the principal. The other $200 that was interest, that's going to show up on your profit and loss. And that would be a part of that general and administrative cost, would be the interest paid on loans. Okay, so those are payroll liabilities and loan liabilities. And then we come to the equity section. So the equity section, something I want you to realize about the equity section. We were just talking about a LLC on the profit and loss. So in the case of an LLC, single member LLC, most of the time we're going to see that the owner has distributions. So I'm looking back at the profit and loss. It showed that there was a $438,000 net income. Let's say the owner of the business paid themselves $120,000 over the course of the year as their owner's pay. That would be right here on this member distribution line. That would show there. Okay. Now, if the business was not doing well and they had to pay in a bunch more, then the member's capital would be the place. So let's say my business isn't doing well, I keep losing money, but I have this 401k from my previous job, and I can borrow money against it to infuse into my business. That would be a capital contribution to your business. So we're keeping track of, if you take money from your personal life and add it to the business, that's a capital contribution. If you take money from your business and put it over into your personal life, that is a distribution. Okay, so you're taking money and, that's reaping the rewards of the profit. Now, retained earnings, what am I going to say about retained earnings? It's a cumulative total. So what I want you to see, before I do, I'm going to do retained earnings, then I'm going to talk about net income. Okay, so retained earnings, this company has $17,813 in its retained earnings. So again, retained earnings can be so not tangible when we're thinking about it, and I want to make it more tangible for you. So I'm just going to give you an example of a company. that is what the retained earnings is. So 17,813. We're gonna round that up to 18,000 so I don't have to do the math in my head. So let's say you start your business and you and actually I can answer Kelt's question here, which is what's the difference between the capital and the contribution? So the capital is money going in or out. So that's your distribution and your contribution total. So in this case, the capital is 66,000. So it's kind of that cumulative total. Say that, so, and that's the same thing that I'm going to say about retained earnings, which is that you're in business. Year one, you lose $50,000. Okay, you had taken $50,000 out of your own personal funds. You've infused it into the business as a capital contribution to get this business off the ground, and you lost all 50,000 of it. You didn't make a profit in year one. So your year one returned earnings is going to be negative 50,000. Okay, then year two comes and let's say you lose money again. So let's say you didn't lose 50,000, you only lost 10,000. So now we're at $60,000, right? Because the retained earnings increased, or we had 50,000 from the previous year. We lost another 10,000. So now we're at negative $60,000 on our retained earnings. Let's say then in year three that we actually made money. We turned things around, we made money. And so instead of having negative 60, we made $78,000. $78,000 was the profit for our business. So when you add that to the negative 60 that was there, you'd end up with this $18,000 positive in retained earnings. Okay, so hopefully that makes sense. It's similar to that owner's capital contribution. The owner's capital is going to be your contributions less your distributions. Okay, the same thing with retained earnings. Okay, and then the net income. So remember how we said that net income is on this profit and loss, the 438,000. This is what you're going to have to pay taxes against in an LLC. The same is in an S corp. You still pay taxes against the net income of your business. It passes through onto your balance sheet. So this is an S corp. The net income was almost $83,000 here, right? So that 83,000 came over from the bottom of the profit and loss, and it's sitting there. Now, what happens in an S corp is you may have already paid yourself as the owner. So we were talking about the owner making $120,000, and that $120,000 would be listed on the profit and loss in your payroll wages. So it would sit here in payroll. And so then if this were an S corp, it's not, it's an LLC. The owner has to pay taxes on the full 438,000. But if it were an S corp, how it would be different is that 120,000 that the owner was paid in salary and payroll taxes were subtracted would be removed from the $438,000 of net operating income. So instead of having a $438,000 net income, the net income would be showing like, $318,000, right? So you'd be showing 318,000. The 318,000 would pass over to that balance sheet and you would pay taxes against it. Now, I want you to realize that you've already had a salary paid of 120,000 and you didn't get 120,000 in your bank account. You got 120,000 less the payroll liabilities, less the payroll tax. So say of 120,000, what was actually deposited into your personal account was 90,000. So the difference is $30,000 over the course of the year. That 30,000 that you've paid on your payroll taxes contributes to the total amount of taxes that's going to be due. So it would be, if you're going to have to pay taxes in this case on 82,921, they figure out that the tax you've already paid is 30,000, you might not even have to pay any more taxes. Okay. So, those things matter. And I just want to clarify that your profit and loss, it's a snapshot of your fiscal year. So say we go back to that example of the business that lost 50,000 in their first year. If your net operating income is negative 50,000, then you're not going to owe taxes because you spent more than you were able to earn. Okay? So that changes. And when it moves from year to year, the retained earnings changes. So this profit and loss, this balance sheet is such that the net income is 82,921. Now next year, that 82,921 gets added into retained earnings and the new net income comes over to your balance sheet. So that can be kind of confusing, but that's why I'm here. And that's why you have invested this time in learning some of these things, because it's going to help you in terms of strategy. So we are at 10:38 and this goes to 11. So this is a great time to ask any questions that you might have. I'm going to start covering the statement of cash flows. So we'll go through the statement of cash flows for the next few minutes. However, I just want you to know that your questions are more important and that the statement of cash flows, it's not used a lot on the day-to-day of your business. I've explained the two big reports to you. I've explained the profit and loss and the balance sheet. Those are the things that we use on a day-to-day basis, okay? So the statement of cash flows is kind of something that's used less in the small business environment, more in a corporate environment, and a larger, medium and large size businesses. Your questions are more important than the statement of cash flows. So if you have any, please share that with me. What I want you to know about the statement of cash flows, here's what it looks like. The statement of cash flows is broken down into three sections. It's your operating activities, it's your investing activities, and it's your financing activities. So financing is paying people back for money that you've borrowed. Investing is things like purchasing assets, things of that nature. And then your operating activities is what happens on the day-to-day that goes to your profit and loss report. So it's made up of those three things, and it is a snapshot. It's a snapshot of what's happening in your business. It's often called the tattletale of the business because it gives you this snapshot of time where we're seeing what was spent on operating, how much cash we need to keep in operating, how much cash we need to keep in financing activities, and how much cash we need to keep in operating activities. Okay. So that's really all I wanted to share with you about the Okay, that's all I wanted to share with you about the statement of cash flows. The couple of questions is where can you see the recording? And the recording goes to the YouTube page for the city of Chicago, and I'm sure that they can provide you a link with that. And the handouts, we'll get an update from Stella if she was able to put those in the chat. And then I just have an offer for you, and I'm going to share that with you. Okay.
Handouts will go out after today. It's not allowing me to do it the way you need it done.
Oh, okay. All right. So Stella says that she wasn't able to, put a link in the chat for that. She tried to linkify it, but that didn't work. So everybody that showed up will get a copy of those financial statements, and you can have them in your inbox and write on them as you see fit. Okay. I have a free resource for you, which is top 5 strategies your bookkeeper should be doing for you, but probably isn't. Definitely bookkeeping is one of those things that needs to be done in your business. People do it from the perspective of being compliant and filing taxes. And while being compliant and filing taxes is important, it's not nearly as important as having the ability to understand your financials and to be an entrepreneurial person to see where the strategy is and where the opportunity is. So, like we talked about the language of accounting and it being similar to learning another language, French or Chinese or what have you. So I really encourage every business owner, this is something that you need to know. You cannot abdicate your responsibility to understand your financials. It's uber, uber important. So this is what is going to be the proof in the pudding. This is what's going to help you be able to run a profitable company, to run a sustainable business so you don't drive yourself crazy, so that you don't get burnt out. And hiring a bookkeeper, well, that's one piece of the puzzle. Your bookkeeper needs to have the heart of a teacher to be able to explain this to you and to be able to set you up to understand what happens next. If I'm spending too much in this area, what happens next? How do I reverse that? How do I change that? If I see that my profitability is good in this area, what am I going to do to double down on that? If I see that, I'm having problems with employees and it's a drain on my company, it's a drain on my energy, then what am I going to do to fix it? These are things that you need to be thinking through, and part of it is going to show in the numbers. So I just encourage you to really, really get a handle on it and learn to speak entrepreneurial accounting, because this is what's really valuable and what's going to drive your business forward. So I have that free resource for you. You can take advantage of that. You know what? I think my chat is blocking the, I don't know if you guys see it that way or not. Here's the QR code. So there's your QR code. If you take advantage of that, you also have the opportunity for us to do a QuickBooks diagnostics report. Our diagnostics reports cost $99. Gives you a very visual view of what's working well in your company and what needs improvement. And that is both from a compliance or tax standpoint, as well as that profitability standpoint and systems standpoint. So we're able to identify in a quick review what needs to change in your business based on compliance and taxes, as well as profitability. So I encourage you to take advantage of that. And the way you would get to take advantage of that is by utilizing this free resource, and we'll follow up with you from that. I don't think I have anything else, and I don't see any questions here. So I'm very grateful for your time today. And I'm going to let Stella take it from here.